Hi, this is Derek Chamberlain with MoneyAhoy.com. We're here to talk about investing in market index funds. And there's four main reasons why investing in market index funds is great for someone new to investing, or some seasoned investors use that as the core to their portfolio. The first reason is simplicity. You can invest in a market index fund like SPY or VFINX in about 1 to 2 minutes every month. So there's nothing to investigate, nothing to research. You just log into your investing software, buy some shares, and you're done in about 2 minutes a month. The second is lower cost. This is a big one. The expense ratios for these funds are typically 0.15% or lower. So they're just buying all the funds that are in the S&P 500. So they're very cheap expense ratio wise. The average cost for an actively managed mutual fund is about 1.3%. So you can see that's skimming off almost 1.5% right off the top every year from your return. So lower cost is definitely good there. Another factor with the lower cost is for actively managed funds. Typically they have more than 50% turnover every year, so there's a high tax rate that you're going to pay on a lot of those funds. Whereas with SPY or VFINX, you're in it for the long run, so you're only paying long-term capital gains typically. The third reason is risk. A lot of times, and I've made this big mistake a lot of times early in my investing career, picking just 2 or 3 stocks that are your favorites, or 3 or 4 stocks that are your favorites. You put almost all your investment money in those. If one of them does badly, it completely torpedoes your whole account. So with investing in these market index funds, you're really investing in 500 separate companies. You've got a lot of great companies, and yeah, you're going to have some underperformers, some pretty crappy companies, but overall it's going to balance out, and you're going to do as well as the market, which historically has returned about 8% every year. And really the final reason, one of the most important for investing in market index funds, is return on your investment. You can research a lot of different articles out there, but I've found typically on average only about 20% every year of actively managed funds can beat a market index fund. So what that means is you have an 80% chance of doing worse than the market, and that's really even before fees. So if you think you're good year over year over year over year at finding that 20%, have at it. But for most folks they have limited time and they really just want to get down to business and start investing their hard-earned money, market index funds are the way to go. Again, I recommend SPY, that follows the S&P 500, or VFINX is a mutual fund by Vanguard that follows the S&P 500. So there you have it. If you have any questions or comments, please leave them in the comments below. This is Derek Chamberlain with Money Ahoy.